how to deal with losing trades. David Jaffe with beststockstrategy.com, and in this video we're going to discuss how you can deal with in the money and losing trades. So around 3 times a year we end up having a position that becomes pretty deep in the money. People think that they're going to win 100% of their trades, but it's not possible to win 100%. You can still win up to 98% of your trades and still have an occasional trade go deep in the money. The problem with selling options is that you have to make sure that during periods when the actual volatility is more than the expected volatility, that you're able to minimize your losses, manage the positions, not incur too much anxiety and stress, and make sure that you don't run out of buying power. And if you're unable to deal with the occasional trade that becomes in the money, then it's highly likely that you should not be trading at all. Think about it. If you're able to win 98% of your trades, but you're unable to deal with the 2% of the trades that end up causing you losses, then you should not be trading at all. I would highly recommend that you go find something else to do, because if you're unable to be disciplined and not get stressed out and not be able to manage your positions, and if you're trading too large and getting too greedy, then there really isn't that much hope for you unless you learn how to be disciplined and patient when entering trades. When the market pulls back, there's always a large volatility expansion event, and that volatility component when selling options usually ends up being highly detrimental to the option seller. You can have a situation where an option that you sold last week when the VIX was trading at 15 is not even being challenged. But if right now the VIX has doubled, then that position can end up showing you a significant loss, even if the current market price of the stock is not even close to the strike price. That volatility component during a large downtrend is actually going to be your biggest enemy. It's not necessarily going to be the in the money positions, but it's going to be the in the money positions in combination with the volatility component that is going to end up causing you a significant amount of stress and paper losses. That's one of the primary reasons why you always have to make sure that you leave an excess amount of buying power so that you don't have to close out positions at the most inopportune time. One way that you can inoculate yourself against dealing with stress of positions that are challenged is to make sure that you always trade small. By trading small, it removes some of the emotion that is inherent in seeing a position turn red and seeing a position go against you. Additionally, when you're trading small, you have much more flexibility to manage and roll that position. I can tell you from experience that when I have an in the money position, I do not stress out. I don't get very anxious because I've had numerous in the money positions previously. And the best way that you can inoculate yourself against the anxiety and the stress of having in the money positions is by real world experience. I would also recommend in general that you trade strikes which are further out of the money and that you trade underlyings which are strong brands. These include companies like Amazon or Apple, or even stocks which are relatively resistant against a recession like Dollar General. You can even trade options on indices or futures like SPY or SPX. All right, so what are some things that you can do in order to manage or trade around a challenged position? The first thing that you can do is sell call options. The second thing that you can do is that you can wait up until the last 10 or 15 minutes of the trading day, so that way there's virtually no extrinsic premium left in that option, and then you can roll out the position. You see, when volatility is high, it's relatively easy to roll positions because there's so much extrinsic premium baked into the option price. So if you wait until the last 10 to 15 minutes to roll that position forward, then you're able to realize a much more advantageous strike price when you roll that position forward than you would if you rolled it too early. Because effectively, the extrinsic premium of the position that you're closing out is going to be 0, but the extrinsic premium that the position that you're rolling to in the future is going to be incredibly high because of the high volatility. As a result, you can use that extrinsic premium that you're rolling out to, allocate it towards the strike price, and significantly reduce the strike price of the option that you're closing out and rolling to. For example, I had a 185 strike on PayPal that was expiring on December 3rd. On December 3rd, at around 3:50 p.m. Eastern, or 10 minutes prior to the market closing, I then closed out the December 3rd 185 strike, and I rolled it out to December 10th, and I sold the 165 strike. I also sold a call option. I think the call strike was about $230. So I financed this entire transaction by having there be virtually 0 extrinsic premium on the 185 that I was closing out. Then I rolled it forward by 1 week, reduced the strike price by $20 all the way down to 165, and I sold a call option, and I picked up a credit, and the following Monday, I closed out the 165 strike put option for about 30 cents. This is a great example of how being patient and disciplined allows you to profit during periods of large volatility expansion events. Because as the option that you currently hold gets closer to expiration, the extrinsic premium will get closer and closer to 0. You can then roll that position forward in time, and then you can then allocate the extrinsic premium towards reducing the strike price of the option. This is how I was able to reduce the strike price of PayPal by $20 just by rolling it out by 1 week. If I had tried to roll the 185 put option on PayPal just 1 day prior, on Thursday, I probably would have only been able to reduce the strike price from 185 to 175. But instead, by waiting until 10 to 15 minutes prior to the expiration of the option so that there was virtually 0 extrinsic premium left on that option, I was able to reduce the strike price all the way down to 165, and then I closed it out the following Monday for about 30 cents. David Jaffe with beststockstrategy.com. If you want to see how I trade, go to beststockstrategy.com/memberships and enroll and follow our trades. It's only $19 for 7 days. If you have any questions, leave a comment below. Please like this video, and I appreciate your attention.